When I was just starting my career back in the early 1980s, I remember going to an investment conference where one of the speakers proclaimed that he only invested in stocks and never in bonds because he didn't want to have to worry about what interest rates were going to do. I can only hope that speaker was not managing money for other people, as the lesson of history is that the level and future course of interest rates is normally among the most important factors in the pricing of almost all financial assets, whether it be stocks, bonds, real estate, currencies, or even to some extent commodities. Please keep in mind the important caveat that the past is not necessarily prologue, and that there's no guarantee that past interrelationships in the financial markets will be repeated in the future. That said, as is illustrated by the gold line in this chart, the Fed funds futures markets are now pricing in a greater than 90% likelihood of the Federal Reserve cutting rates for the first time in years at the September 18th Fed meeting. As such, we thought this would be an opportune time to discuss the traditional impact of lower interest rates on stock prices. We believe that this relationship is both less well understood and less universal than is the case with bonds and real estate in particular, where there has traditionally been a very strong indirect relationship between interest rates and prices. In other words, they tend to move in the inverse of one another. That said, as is illustrated in this graphic, there's also a relationship between interest rates and equity prices. To explain, this chart compares the 10-year Treasury yield in blue with an inverted chart of the percentage of the New York Stock Exchange stocks trading above their average price of the last 200 days in gold. In other words, it shows the historical relationship between interest rates and market breadth. While not a perfect correlation, you can see that fewer stocks trended higher when rates were either high or climbing, and more stocks trended higher when interest rates were low or trending downwards. Put another way, lower interest rates are traditionally bullish for the average stock. Further, it's traditionally true that investors have historically been willing to pay more for each dollar of corporate earnings when rates are low or falling, thus allowing equity markets to trade at higher price-to-earnings multiples when rates are low. As noted previously, this relationship between interest rates and equity prices is arguably not quite as direct or as universal as is the case with bonds and real estate, particularly since history shows that certain types of equities tend to be much less interest rate sensitive than others. Indeed, we believe that one of the major reasons for the past 2 years of dominance by mega-cap technology stocks, presumably because they have relatively little need to borrow money, is because they prove largely immune to the impact of higher rates. On the other hand, since these huge companies were not significantly hampered by rates going up, they're also arguably less likely to benefit significantly by rates going down. In contrast, lower interest rates have historically proven highly beneficial for smaller companies, which tend to carry a heavier debt burden, are more reliant on adjustable rate debt, and are normally required to borrow at higher rates than their larger brethren. You can see this impact of lower rates in this chart, which shows that over the past 70 years, smaller stocks have on average outperformed mid and large capitalization stocks in the 3, 6, and 12-month periods after the first rate cut of the cycle by the Federal Reserve. The same has largely been true of value-oriented and even many high-dividend stocks, which tend to be very sensitive to both interest rates and the strength of the economy. Now, this is certainly not a reason for an investor to consider selling off the large growth stocks that have powered the market for the last 2 years and moving all their money into smaller and value-oriented stocks. However, if lower interest rates do catalyze an improvement in market breadth, as history suggests that they should, it could finally allow investors to diversify their portfolios beyond the current narrow group of leaders without necessarily needing to compromise their potential for attractive future returns. Thank you very much.